For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. This is Managing Your Financial Future, the award-seeking program.
Award-seeking?
Yeah, well, that's us, right?
We're looking for one.
I've been looking for years for one. They just, they don't...
haven't offered it to us yet, have they?
No, but I'm still looking. And if anybody wants to give us one, please do so. I'm Johnny Dean, your podcast host, here with Professor Rick Plum. Not a real professor. I'm a real podcast host, but you are a real financial advisor, a certified financial planner professional. Are you not? ?
I am. And I'm looking for that national award, that big leg lamp from Christmas Story.
Oh, yeah. Wouldn't that be cool? They do sell those.
I have a small version on my desk.
They sell those all over the place. It's pretty funny. Anyway,
a major award.
Well, yeah. It's nice when somebody else gives you an award and you don't have to go out and buy one yourself.
It's a major award.
It is a major award. All right. Anyway, this is Managing Your Financial Future. Speaking of award, I'll tell you what, we should have gotten an award this season. First of all, this is the 13th episode of whatever season this is. I've lost track. We usually do 12. We're giving folks a
baker's dozen.
A baker's dozen, right? We're giving you the extra episode because I tell you what, this season has been stellar. I mean, if you've really listened to these episodes, these have been wonderful.
So does that mean that we get a little reprieve after this one?
Well, what we're going to do is, we do 12 usually. Now we're doing a 13th because we're going to follow up on a topic from last week, kind of, and we teased it. And then you a couple of weeks off where you might get one from last year or somewhere, and then we start back up again. So this is that 13th episode, but we've been so good. We've been on such a roll. I didn't want to stop.
Okay.
So I brought you back in. Plus, as I said, I teased it last week, so we kind of have to do it this week. Big topics this week, and we'll tell you more about the next season's topics, but we got a little time before that. Last week, Professor Plum, we talked about QCDs, Qualified Charitable Distributions, and how they relate to estate planning.
And how they relate to your bucket plan.
Yeah, they really, exactly. And this has to do with inherited assets and things like that. And I wanted to extend that, not really on the QCDs, but on the inheriting of the assets. A year or so, I guess it was like last September, we did a podcast on the best and worst assets to inherit. And usually, there's no such thing as a bad asset to inherit.
If somebody's going to leave me some assets, I'll take them. I'll pay the tax if I have to.
I'm fine.
I would prefer it be a big Roth IRA, which gives me most likely 10 years to let it grow, and then I have to take it all out.
Happy to have that. I suppose if I inherited my uncle's ferret farm, I don't know that I'd want that. But pretty much any monetary asset, I'll be happy to.
Anything that's harder to get rid of than it's worth.
My uncle doesn't have a ferret farm. I should mention that. Anyway, but there are very few assets that you don't want to inherit. It's just some are more tax efficient than others. And one of the things that gets inherited quite a bit, I would assume, are these IRAs.
Yes,
an IRA is a
common.
Very common asset to inherit, maybe more so than 401ks or anything like that. People have IRAs, and since the required minimum distribution rules will never technically empty the IRA.
For the owner.
In many cases, they wind up being passed to another generation. So first thing I want to get to here, Professor, let's just get the housekeeping out of the way.
Although the percentages for the owner do get rather large when you get up into the 115, 116 years of age.
Age 116.
You got like a 30, 40%.
Don't they go to 50% at some point?
Yeah, pretty close. I can't remember the final factor that stays with us. It might be a little over 50% of what the previous year's balance was.
Yeah. I've wondered, celebrities. I thought of like Dick Van Dyke. Now as of this recording, he's still alive, but he's almost 100 years old. He's in his late 90s, and I think, boy, that guy's got to be, he's got some substantial retirement accounts, I would think. And
does he, or does he just have a substantial net worth outside of retirement?
Well, that I don't know, but these are the kinds of things I think of.
As a clear, he's not a client of ours. We do not know his finances.
No, I shouldn't say
Darn
that.
it.
But you think of these people, yes, as you get into your late 90s, and if you make it past 100, you start to get rather high percentages, but you're never going to be forced to take it all out.
100%, yes.
Even if you only have $15 left in it, maybe your RMD for that year is $7.50. I don't know. So, but there are some
IRA fee is $30.
That's right. There are some not rules. Well, there are actually.
Well, there's rules about all of this.
Talk about what's new with inherited IRAs. Even though it's not really new, it's an extension of last year.
Well, the newest thing was a couple months ago, we learned again that for those people who are in the 10-year rule where the original owner of the IRA died after 2019 and was taking required minimum distributions, we've got the waiver again. I did not think they were going to do this. The IRS has waived the penalty if you are an eligible a designated beneficiary of an inherited IRA after 2019, and you're within the 10-year rule, and you were maybe supposed to have taken some out in the last couple of years. They still haven't finalized the regulations, so they say they're going to waive the penalty again for that category of beneficiary.
So if you haven't taken a required minimum distribution from an IRA that you inherited 2020 or later, there's no penalty for not having taken the RMD.
Yes.
And you will have an RMD regardless.
Well, there is an RMD, but you just won't get a penalty for it for that category of beneficiary.
Right. So no harm,
That's relatively new. That's only a couple months that we've gotten that information.
Well, and they've done this every year for the last 4 years now. Yeah. So there you go.
Maybe they'll get their stuff together and actually issue the final regulations between now and the end of the year. So, or hey, if they don't get their stuff together and they go into 2025 and they get 3, 4, 5 months into 20, they may waive it again.
They may. I don't know.
Who knows?
I think they're done with this whole inherited IRA thing for the year. I think they're going to table this till next year.
That's what they pretty much have.
Yeah. All right. So let's talk a little bit about inherited IRAs. For some people, we mentioned last week, you mentioned that if you're charitably inclined and you've got an IRA and you've got a personal account and you'd like to give money, maybe it's a little bit more tax efficient to give the IRA to the charity or a portion of it.
If you're eligible, if you're 70 and a half or older, I think the QCD, Qualified Charitable Distribution, is I haven't found a reason not to do it that way yet.
Right, but for the charity to inherit the IRA rather than your heirs.
Oh, you're talking about after you pass away?
No, after you pass away, yes.
Oh, I mean, if you are going to leave money to the charity, your charitable giving legacy needs to be coordinated with your overall estate plan. And you want to make it, just like we were trying to make it last week, we talked about the QCD and ways to make it efficient, maybe save some tax dollars on your charitable giving. You want to be charitable giving. Let's make it as efficient as possible. Well, that doesn't stop at death. Let's make it as efficient as possible. So if you're going to give some money to charity, giving them IRA assets, tax deferred accounts, that would be taxable to your other beneficiaries. Giving it to the charity
makes
sense to me, because charity's not going to pay tax on it, and that gives more of the personal money, the Roth money, or to give to the non-charitable beneficiaries, who presumably won't have to pay as much tax, because if I'm receiving your stock portfolio, your real estate portfolio, your house, whatever, I don't have to pay tax if I turn around and sell that, because I get a new basis under current law.
We should say it's all under current law as of this recording. All right. So, but not everybody gives to charity. So oftentimes, as we said, people inherit IRAs. Now, there are some things that you need to look out for. I would just to sort of guide this along. Would you agree that spouses probably have the most leeway?
Heavens, yes.
If your spouse passes away.
We've been talking about Secure Act 2.0, how it changed the required minimum distributions for beneficiaries, and it did not change anything for spousal beneficiaries. So spousal beneficiaries, the rules haven't changed for them. They can still take it over as their own.
Explain very quickly if you inherit an IRA from a spouse.
So if I inherit an IRA from a spouse, I can roll it into my own IRA as if it had been my IRA since day one, or I can leave it in the decedent's name, making it a beneficiary IRA, but I won't have to take any required minimum distributions until that individual, the original owner, would have reached the year they turned 73. And then I base the RMD based on their age. And so those are the basic rules. And
there are reasons for doing one or the other.
If I'm inheriting, if I'm a younger spouse, and maybe I want to have access to that money that's in my late spouse's IRA, 401k, tax-deferred retirement account, I want to have access to it. I want to leave it in their name. I don't want to put it in my name. I may be 45 when I'm inheriting it. If I take it over and put it in my name as if it were mine from day one, now it's my IRA. And I cannot get to it until 59 and a half without a penalty.
Yes, or without 72T or whatever.
Yeah, or without a structure payment,
correct.
all these substantial legal payment plan. So leaving it as a beneficiary IRA, assuming my spouse wasn't 73, 4, 5, 6, or older, I don't have to take any money out of it. And I can leave it alone. I can take money out or not take money out. I'm either in or out. I can do anything I want with it until that person would have been 73 or maybe 75, given today's world, if you're born in 1960 or later. And so it gives me a lot of flexibility. Now, on the other hand, if I know I'm not going to touch the money, we did our planning appropriately. We have enough assets, life insurance proceeds, and things of that nature to get me through the next, umpteen years until I'm 59 and a half.
As a spouse.
As a spouse, as a single individual, maybe a single parent raising, kids and all. If I do not have to touch that money, then I probably, just rolling it over to my own name makes it a little bit easier. It makes it easier also because now I can play the tax game and do conversions, move it over to Roth and do some other things. So how the spouse treats the IRA, but these rules are not new. This is what we've been doing with spousal inherited IRAs for quite some time because those rules did not change.
All right. So in many circumstances, it's not the spouse who inherits the IRA. It's
at
an
some
easier
point,
thing.
somebody other than a spouse is going to inherit whatever's left.
Presumably, yes. It's going to be a child or somebody else who inherits the IRA.
Most people don't spend their IRAs to zero by the time they die.
Yeah, and you've seen it many times.
If you live to 95, 98, 90, 100, okay, those people do. But people that make it into their late 70s, early 80s, they typically have some IRA, tax-deferred retirement accounts left over.
So if I'm inheriting an IRA from, let's say, a parent or it's just somebody else, I'm inheriting an IRA. There are things that I need to be aware of from a tax standpoint. There are things I have to do, and there are things that I should do. Talk a little bit about some of the things maybe that I need to do.
Well, the fact that the penalty has been waived doesn't necessarily mean you shouldn't be taking some money out of that traditional IRA that you inherited because you're subject to the 10-year rule. For anybody who inherited an IRA from somebody who died in 2020 or later and is not what they call an eligible designated beneficiary,
like a minor child or
somebody under 21, somebody who's chronically disabled or ill, or somebody who's within 10 years, within 10 years of my age, they have their own set of rules. Those are eligible designated beneficiaries. But the rest of us are designated beneficiaries, and we are going to be subject to the 10-year rule. Now, whether the person was required to take some money out or not during years 1 through 9, even if we're not required to take some money out years 1 through 9, it doesn't mean we want to leave that traditional IRA growing for 10 years and then take it out as a lump sum.
Within the IRA.
In one lump sum in the 10th year. That could be a very taxing experience unless it fits into your plan. So there are reasons to look at if I'm inheriting an IRA, how should I treat this asset? First off, what do I want this money to do for me? And no, I don't necessarily mean I'm going to go buy a Ferrari the next day. It's a matter of how do I make this money work as best as possible within my needs, my given constraints, and my tax brackets. The fact that I may not have to take any money out this year doesn't mean that I might not want to take some money out this year, because I may have room in the current tax bracket that if I just leave it alone for 10 years, presumably that money could close to double, and then it'll be twice as taxable.
And as a reminder, when the money comes out,
it will be taxable when it comes
out. It's taxable in your
whatever your current tax bracket is.
Whatever your current tax bracket is.
And do we think tax brackets are going to go down over the next 10 years? Now, maybe yours is because maybe you're inheriting it at age 59, 60, and you're going to work for 5 more years. And then you're going to retire at 65, 66.
Perhaps.
And your overall income will come down and you have more room to be able to. So in that case, maybe you take as little as possible for the first couple of years. And then when you retire and the next year you don't have any income, start using the inherited IRA money to basically replace your income that you're no longer receiving. So it becomes part of bucket number 1. It's all part of a planning process. Which accounts fit best where?
I know there are some people who are saying, gee, can I take what I was supposed to take out and put that into a Roth IRA, convert that into a Roth? Now,
inherited IRAs, no. Required minimum distributions, no. So let's put that one at ease right now.
So if you inherit an IRA and you take the RMD out and you say, well,
if you inherit an IRA, any distribution, whether it's an RMD or otherwise, cannot be converted to a Roth.
That's what I want to make sure that people understand.
You cannot convert inherited IRA distributions.
Yes, yeah. And, of course, to contribute to a Roth, you can only put in W-2 or 1099 or net.
You have to have
income.
Earned income of some form.
Correct.
To be able to contribute.
Yeah. So forget the Roth idea. But you are going to have to pay taxes on this particular transaction. And that really is kind of the driving force, I think.
Right. Where is it most beneficial to pay the taxes? Is it more beneficial this year because I'm in a low bracket for whatever reason? Mm-hmm. Or will I be in a lower bracket within that 10-year window enough so that deferring it makes sense? Maybe I take a little bit out to keep the growth from going crazy so that I can take, maybe it's $200,000, just purely making numbers up. And so I take 8 to 10 out a year. So I keep it right around 200, maybe stunt the growth a little bit so that when I do retire 5 years from now I can take 40, 50,000 a year out and I'll be still in my lower bracket because all I have at that time is maybe, maybe nothing at that point. Maybe that's what I'm living off of.
Correct.
And pay very little tax at that point rather than taking a big chunk now while I'm working and bumping brackets.
So it's really the strategies around this stuff when you're inheriting an IRA are, for the most part, tax plays, really, correct? I mean, anything beyond...
Spending and tax plays, yeah. It's all about... First off, we have to, get over the urge to spend it all the first day.
Well,
and unfortunately, people see inherited IRAs as found money. And it's almost like a windfall. That
right.
Unless they've known about it and have basically warmed up to the idea that this is going to be their money. It's not a matter of, this is what Dad would want me to do.
Want me to take the cruise and bring the grandkids or the kids, and
everybody along,
and bring the cousins.
And some people will look at it that way. So figuring out how you're going to look at it, it's nice to then, what is the most efficient? I fall back on that word, efficiency.
Yeah.
What is the most efficient way to take it out to meet the goals that you've set? Now, sometimes the goal that you've set is, I want that Ferrari.
Or the goal is,
that's
I don't have, I can't, I'm a little behind. I kind of need this money.
Right. And so let's start taking it out now. In the old days, we could stretch it out over many years. Now we can only stretch it over 10 at the end of 10. But that's a tax play. At the end, it doesn't mean you have to spend it. An RMD does not have to be spent. It just has to be taxable. That's all that matters. They don't care what you do with it. And building a personal portfolio, if that's what it takes, I take it out and pay taxes on it, and I start investing it personally for me for the future. There's nothing wrong with that either.
Yeah.
I mean, you don't have to spend it. We just like to.
Now, years ago, we used to talk about something called IRD, income with respect
to a decedent.
To a decedent. And the estate tax limits 20 years ago plus were a lot
a lot lower?
A lot lower. And by a lot lower, I mean it was $650,000, $1 million, whatever.
600.
It was 600 at one time.
Before that, it was 250 or half the estate up to 250.
Yes, and at the time, as I recall, if estate taxes had to be paid or were paid from this IRA, the beneficiary would be able to, I think, deduct those taxes, right?
We could deduct the income tax paid on the IRA against the estate tax or vice versa. We haven't dealt with that for a long time.
But you don't really see that anymore.
Because we don't see the estate tax hitting most people. Most people are not paying estate taxes.
Yes.
Or most decedents, I should say, are not paying estate taxes. The recipients, the beneficiaries of estates are not paying estate taxes. Because a married couple has that $26.2 million available to pass now.
Amazing what happens when very wealthy people pass tax laws.
It'll be interesting to see what happens towards the end of 2025 when this becomes a serious discussion point, because in 2026 it automatically sunsets and goes back to $5 million plus inflation. So maybe 5.65, call it $6 million per person instead of 13 plus per person.
Yeah.
It'll be interesting to see what the fat cats in Washington do about that. Are they going to let it drop to 5 million?
I don't think
they will. I don't know.
I guess we'll find out. A lot of things are going to happen at the end of 2025.
Well, the current tax code sunsets and a lot of things change. We revert back to the 15, 20, 25, 28 instead of
I've forgotten. I'd have to go look at my
instead of the 12, 22, 24.
The brackets are going to go back up.
We revert back to a lower standard deduction, but we bring back personal exemptions.
Hey, that was helpful.
It might be. We lose the SALT deduction or SALT limitation.
Hey,
the state and local income tax. All of these things are set to expire at the end of 2025 for the new 2026 tax season. We'll see.
Well, we'll find out. So speaking again about inherited IRAs, there are a few other things I think that people need to be aware of. Specifically, I would say, Professor Plum, that if the person who died, the original owner of the IRA, was in a required minimum, at or above required minimum distribution age.
Well, that's what the IRS is trying to finalize right now. When the rules came out in 2020, everybody that was a designated beneficiary that was not within 10 years, was not a spouse,
right?
had a 10-year time clock, but there was no mandatory required distribution in years 1 through 9.
Well,
but the IRS looked at that and said, "No, Congress passed it that way."
Yes,
but Congress is somewhat clueless about taxes, and it went against an overriding doctrine that RMDs have to be continued for people who are taking them. And so they're supposed to come out at least as fast or within a certain. So there was this doctrine that you can't just stop taking RMDs. You got to continue taking RMDs. So that they worked them into the regulations, said, okay, for people who were at the required beginning date or later, basically taking their required minimum distributions, they're going to be required to stretch to do exactly what we used to do with the IRAs as a beneficiary with a 10-year cliff, meaning if we're going to stretch it over our life expectancies for years 1 through 9, we're going to, if I'm 55 and I've got a 35-year life expectancy, I take out 135th, 134th, 133. But then instead of stretching it for 35 years,
you're done at 10.
And in the 10th year, whatever the factor was supposed to be goes to 100%. Come on now. And so, but that isn't in the final regulation yet. But that's what we're supposed to be doing.
But now, somebody who dies in January and has not taken their RMD for that year yet.
Well, the required minimum distribution for the year of death is always the owner's. And
that's what I'm talking about. The year you died does not.
Right.
Those rules you're just talking about.
2nd or December 30th, your RMD is your RMD. If you haven't taken it yet, the first thing that should happen is your heirs take that. And
at whatever you were,
whatever your RMD was.
The owner who passed away, their RMD still must come out.
Yeah, so somebody who's 75 years old who's passes away unfortunately early at 75, their required minimum distribution, they have $1 million IRA, their required minimum distribution may be $40,000, give or take. And they die January 15th. They haven't taken a dime out yet. Their 27-year-old grandson or granddaughter inherits it. They have a 50-year life expectancy. I don't know the exact number, but it's quite a ways. The required minimum distribution for that year is that $40,000. And then the next year, it'll be like $4,000.
But because there's no penalty for not taking out the beneficiary RMD, that does not mean that you. Oh no,
the first one, the benefit.
That's where I'm going with
this. The decedent, the owner, there's still that one has to be made.
Does that first year, if they died in January, now that first year they take out the original owner's RMD,
right? And then
where does that 10-year clock start? Then does it start if they died this year?
If they died this year, this is the first year of the 10-year clock,
and
then we get next year's year 1.
The next year for the beneficiary becomes year 1.
That's your first year of required. Then you got 9 of stretch IRA, and then you got a 10th year that 100% has to come out.
All right, so talk for just a little bit here before we have to wrap up the podcast. There are strategies that you can do when somebody has, and you alluded to them a little bit ago, but maybe just expand for a moment on those strategies that people need, things that people really need to be aware of, especially if they're in their prime earning years. You mentioned. If you're in a high tax bracket now, but you expect sometime in the next 10 years to not be, maybe you take just a minimum out. Is the key normally to lower the balance of that IRA before you're required to take everything out in 10 years?
Well, this is where we go back to the standard answer.
It depends.
It depends.
Yeah.
It depends on what's going on in your life, what's happening. Is your income going to go up? Is your income going to stay flat? Is your income going to go down? Are there any events happening in the future that you're going to need this money quicker than just taking 1/10, 1/9, 1/8, 1/7? Looking at your tax bracket. The idea is, let's try to make it as efficient as possible. But again, let's build it into your needs. Maybe you've been waiting for this money to get out of debt. Maybe you've got some credit card debt that's at 29%.
Well, then paying the taxes probably makes a little bit of sense.
Yeah, paying maybe the next bracket up and getting rid of that debt.
Yeah.
Maybe you want to get a bigger house for the growing family, and this helps you get into that, and it may be worth it. So there are family and driving factors outside of taxes that can override the tax consideration.
Yeah.
There's needs. Darn it, we have some needs.
I had somebody ask me this year, this goes way, way back, and said, well, look, what if I'm in my prime earning years, but I've got a kid who's like earning nothing? And I say, well, I just inherited this IRA. Can I just say, I don't want it. This can go to my kid and let them take it out? And...
If that's an issue, you can disclaim inheriting an asset. And then unless there's a contingent beneficiary listed who, if you've done a lot of planning ahead of time,
yeah,
or the person who died did a lot of planning ahead of time,
yeah,
and I disclaim it, and my kids are the contingent beneficiaries on this, I'm basically stepping out and saying, I'm not.
I
part
don't
of
want
this.
it. Yeah.
And so it'll bypass me and go to the kids. But most people don't do that. So if I disclaim it, I step out of it. Now it goes to whoever the state says gets it. It's basically a probate issue. So depending upon what state you live in.
Oh, if you don't have a contingent beneficiary.
Yeah, if you don't have a contingent beneficiary, now it's part of the estate,
yeah,
and it's going to get passed, and it's as if I didn't exist, and then you get passed down to however the state,
they deem,
who gets it. I mean, so that could be a little bit of a tricky issue, or you could name your trust, and the trust outlines who gets it if you're not available. So there are ways to do it.
Yeah. Okay.
But that takes a little forethought.
When how does this relate to, say, a bucket strategy? Where does this fall in generally? I mean, do you like to use a lot of this for bucket one, or how does this normally
work? Well, with an inherited IRA that I know I have to take out within 10 years, let's say I'm getting ready to retire, or I just retired.
Yeah.
And I'm one of the normal people out there that has the predominant value of all my retirement or my investment accounts inside of an IRA, tax deferred. How old am I? I'm 65. Well, I'm going to use this inherited money, depending upon how much it is, for bucket number one. I have to get rid of that for the next 10 years. I don't have to take anything out of my own IRA for the next 10 years.
Good point.
Or for somebody who's really, on the other side, maybe they say, I'm going to only take the required minimum distributions for the first 1 through 9, and I'm going to use up my tax bracket converting my current IRA to Roth IRA. I can't do that with the inherited IRA, but that would be something that would be an option. So instead of taking a bunch of money out of the inherited IRA, but that then means that there's going to be a big distribution in year 10.
By year 10,
then
right.
I just shoot myself in the foot. That's just a matter of how much we're doing.
And now we're back to it depends on your situation, right?
Well, it always depends on this kind of thing.
Yeah.
Unlike the QCD, where I can't find a reason not to do it if you're charitably inclined. This is all about, what are you trying to accomplish? Where are you? Are you 35, 45, 55, or are you retired? Are you taking your own required minimum distributions?
Yeah.
Do you have a spouse that has to take required minimum distribution? Are we taking more than that to live? Can I reduce those and then take more out of this so that I can get rid of this so I don't have 3 freaking required minimum distributions?
It really all comes down to your individual situation, and there are almost an infinite number of different scenarios.
How many people are in the U.S.?
Well, and it also comes down to making sure your financial advisor understands what your options are and what questions to ask you. If you're going to try to do this stuff on your own, and this is why I'm bringing this up, and you get an inherited IRA or a couple of them or whatever it is, you better know what questions to ask of somebody, or you better know how this works. Or you could either get hit by both taxes and penalties, or you're going to wind up paying way more in taxes than you were supposed to.
I just don't like paying taxes. I don't know anybody that really loves it. I know people that really hate it.
Well, many people, I mean, this is part of the, I hate to call it a game, but it really is part of the game, is to see, well, how much are we absolutely required to pay? Right. And is there a way to potentially reduce that. If not this year, then next year.
But as I said earlier, there are life factors that sometimes override and say, you know what? Taxes are not the worst thing.
Yeah.
I have a problem with this. I need to take care of that. That overrides it, so we're doing it for that.
Exactly.
So let's find out what's happening in your life.
We also have, by the way, you want to know about estate planning? This has to do with this.
Guide me through this.
There's the estate planning guide that we have available for you at luciacap.com. Just search estate planning in the little search bar up top. You've been hearing me talk about this. We've also got the bucket strategy guide. A lot of this stuff is mentioned in that as well. Ways to strategize in your bucket strategy. Type in buckets or bucket strategy in the search bar at luciacap.com. You can download this PDF, read it at your leisure, and really learn something. I think this is an important thing to do. LuciaCap.com is where you get more information on all this stuff as well. You can get in touch with Professor Plum or any Lucia Capital Group advisor at 800-644-1150, 800-644-1150. Or as I said, go to LuciaCap.com. Don't forget to subscribe to this podcast, Spotify or Apple Podcasts. This has been a great season. Did I tell you that at the top of this?
This is the last of the season.
That's right. This is our Baker's Dozen. This is our 13th.
I get a vacation?
Well, a couple of weeks. Hey. Well, in the summer, I mean, this is where we're, we may take that, but we're not really going to take a vacation.
Just from the podcast microphones.
Well, for a couple of weeks after this, but you'll still be able to hear some stuff that we've done before. But we got a whole new season coming up, maybe new guests. Who knows?
After 30 years, I get 2 weeks off.
That's all you get, man. But you get it every 12 weeks. So
okay.
Technically, you've got it like 3 or 4 times a year. Oh, hey, we're just happy to say, you know what? We're happy to be above the ground, right? Yeah. That's what we are.
Given my age.
Given both of our ages. Holy moly. Apple Podcasts or Spotify. Professor, thank you so much. I'm going to let you get back to work. I know you got stuff to do.
Thank you.
I appreciate that. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. This has been Managing Your Financial Future. Thanks so much for listening, and we'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstance. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. LPL Financial Insurance License Number 0518721. LPL-IA Insurance License Number 0B91442. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.